All right, so we're switching roles a little bit here today. Previously, Jordan has interviewed me. Now I'm going to interview him because he wrote a book, and the book is very high quality. In fact, I think it's maybe the best technical analysis content on precious metals I've ever seen. Maybe that's high praise, or maybe it's just a low bar. I don't know. Jordan, the Daily Gold, how are you today?
Hey, I'm doing great. Yeah, thanks so much for having me. Can I call you Goldie? I mean, it's your show, so
You
you
can
let me
call me
know.
Goldie. You can
Yeah,
call me Goldie. Yeah.
yeah. Thanks for that very kind intro, and thanks for having me on, Goldie. Great to be with you. And technical analysis. I'm sure this is a subject near and dear to our hearts.
Yes, it is. Yeah. So it's not often that I come across content or a book, especially in finance, where I'm like, this is actually really valuable. Like this is not just somebody wrote this because they came up with a good title and some good cover photos to sell it. This is actually really deep research. This is really high quality content. And this is actually laying out some real facts and maybe helping us to get rid of some misconceptions that have existed in the precious metal space for decades, quite frankly.
Yes. Yeah. So I wanted to basically, well, let me stop there for a second and go back. The timing was really, really good. I mean, this is kind of the third edition of the book, although I think the first two editions were not quite as good. I mean, the first one, I think my macro view was incorrect in 2015. The second one, I think in 2019, I started to solidify it with this comparison to the 1960s. The stock market's in a secular bull, but gold and silver, they've clearly put in a bottom, but they're not outperforming the stock market, so they're not quite in a real bull market yet. And then I can't recall if I talked too much about the bond market in the second one. I probably did a little bit, but then with the secular bull, that nearly 40-year trend in the bond market, with that ending in the I should say it really ended maybe 2022. Based on the total return of bonds falling below a key moving average. I think that really helped me crystallize just the very big picture and where precious metals are. And yeah, I mean, there's a lot of misconceptions out there, and just people don't understand that precious metals, they are an asset class. I mean, you have stocks, bonds, and commodities, and gold is kind of the head of commodities. So you can look at it as stocks, bonds, and gold. I mean, those are your three major asset classes to dumb it down. And so gold and precious metals as a whole, this is just an asset class. This is a market. Markets move in secular trends. They move in very, very long-term trends. And so I really wanted to get that point across. And then in the book, talk about, okay, where are we with respect to these trends? And, the timing, I think, turned out to be really, really good, because we're seeing these trends in some cases shift, but really it's at this point, it's becoming more obvious, especially in the last couple months, with gold breaking out against my 60-40 portfolio, and gold finally breaking out against the stock market, a 4-year trend there that was, gold finally conquered that. And so I think that, I'm going into some of the important points of the book, but yeah, I mean, just circling back, gold is just an asset class. I mean, it is an investment. It has its own characteristics. The minors and juniors, they have their own characteristics. But this is an asset class. We're going into a new real secular bull market that could last a decade. The same is true for commodities as a whole. And, a lot of the points I make in the book, it supports that. So, yeah, it was really written from an investment standpoint. I want to get the big picture across, because when people understand that, they can understand where this market is going, and that can help them invest based on, not just the next year or two, but the next 5 years, the next 10 years.
So we'll delve into some of the key points that I extracted from the book and pick your brain on those. But first, just thinking back, because so you've been basically an analyst following precious metals, writing about precious metals, and even mining stocks for more than a decade. And so I'm just kind of interested to hear you talk about the last few years and looking at gold price, gold technicals, gold in different currencies, gold relative to the S&P 500, all the different ratio charts, and various market analysis that you do, seeing that and observing it evolve 2021, 2022, 2023, and now entering 2025 against the backdrop of the macro conversation. So the fundamental narrative for what's happening in the global economy with the macro, the Fed, and all of that. How has it been to see the technicals and then the fundamental narrative? You get what I'm trying to get at? Has the technical price action led the narrative, or is it basically simultaneous? You get what I'm getting at?
Yeah. No, it's a really good question, and I'm thinking about how I can delve into that because typically technicals lead, and technicals they're not necessarily a catalyst. Maybe they're more of a context, and so we could see this cup and handle pattern setting up even a couple years ago. It was even something I was thinking about in 2020 when we got the huge COVID move. I was thinking okay, this is gold is going to peak at 1900 and we're going to do this cup and handle for a couple of years and then it's going to have a huge breakout. But I mean, gold even went further, still wasn't a cup and handle. The handle lasted several years, but I'm talking about that because the setup was there. The context of the market, this technical setup was there to produce a really, really big move. And we did get the breakout, but it was interesting. We got the breakout before gold had broken out against the stock market, which of course is 60% of the 60-40. So to me, I think that, I think that technicals lead, but that to me was really the key in March was gold breaking out against the stock market, because we can see when that happened, more money was coming into precious metals. At least for me, it really seemed like a lot more money has been coming in. The stock started to heat up, even though they already made big moves. But to me, that was the real turning point. And so, narratives, as narratives tend to follow price. So I'm kind of less concerned with the macro narratives, I guess, because now we're so clearly in a bull market in precious metals, and how gold moves, people will attach narratives to that. So the narratives will come second. For example, if gold is in a correction now, for, I don't know, 2, 3, 4, 5 months, it consolidates, it consolidates bullishly or corrects, some narratives will be attached to that. Oh, maybe we're going to have less uncertainty. We're going to have some certainty with respect to the trade war, and maybe things will calm down a little. That narrative will be attached to why gold is correcting and consolidating. But as the gold market is ripe for a correction and consolidation even before that narrative comes about. So I think in many cases, the narrative, at least publicly with respect to the news, that comes after the price. But yeah, I mean, smart people and the Wall Street investment banks, I mean, they're coming up with narratives and reasoning for these moves, at least really quickly. They're thinking about that stuff. But I'm probably less focused on the narratives. I love intermarket analysis and just looking at how are all the markets moving, because that plays a big role in capital flows. When you can chart markets against each other, you can see, I tweeted something a couple of days ago, okay, gold against the stock market, gold against the S&P, it's made this huge move up. And I've been thinking, interim peak is coming for gold. Maybe the stock market could do a bear market rally at the same time. So you look at this gold against the stock market chart, you can see it's gone straight up in the last couple of months. It's basically right at 10-year resistance. And so that tells me, okay, we can see capital start to shift around. Like we could, see a pause in this move where, maybe the stock market will outperform gold for 2, 3, or 4 months here. So I think if you look at the right charts and relationships, you can kind of get a sense of maybe what markets are going to do, and then at the same time you can think of what narrative might be used to drive that trend.
Yeah, that's a good point. Yeah, so the narrative comes after the price action starts. So when we start to get a trend change or an acceleration of a trend, then the narrative comes about, and you start to get new research reports from Wall Street banks and newsletter writers and journalists start telling the story to fit the price action. So thinking back on the last 6 months, I can think of a couple of narratives that have come about. So after the election, November 5th, gold peaked and started to accelerate to the downside in early November. And literally 2 days into the sell-off, this narrative came about that, the dollar wrecking ball, Trump is actually going to be bullish for the dollar, negative for gold. And then they started to craft a narrative that Doge is going to cut the deficit. So the deficit's not going to be as big. The dollar is going to be stronger. They just crafted a narrative, and so that worked for a week. Gold had a correction for a week, but then fade the scene to early January when Trump is about to take office. And then all of a sudden, gold is starting to move back up again. And all of a sudden, there was a chart pattern. It was like a pennant on the daily chart. And then it just broke out from the pennant, and the long-term trend, reasserted itself. And then there was a new narrative that formed that, actually, Trump is negative for the dollar, and maybe that's good for gold. And now the third narrative maybe is about to come about, which he said, because gold has had such a big move in such a short period of time, and it hit 3,500 faster than I think almost anybody thought it would. Now we're in a correction, or at least a consolidation. And so maybe a new narrative could come about that, the tariff stuff is not as big of a deal as it was, and the dollar needs to have a bounce now. And so we can sort of create a shorter term narrative, but really it's just following the price action.
Right. But I also think the key is, as I said before, because you don't want to get into a situation where you're completely ignoring the news and what's going on, and you're just, you have your head buried in the charts, because looking at the charts is great, but you have to look at, sentiment, capital flows, and, general fundamentals at the same time. I try and piece all that together, because if you're only just looking at, if you're a fundamental guy who's not looking at the charts, you don't know what's going on in the actual market. If you're looking at only charts, you're ignoring, fundamentals, sentiment, and maybe larger capital flows. So you have to, I'm just saying that because I don't want people to think, it's only the chart, or just look at the chart. I mean, that plays a big role, but you have to look at these other factors. And getting back to intermarket analysis, that I think is so helpful, because again, you have stocks, bonds, and commodities, and in the way that most money invests, I mean, they have to choose between these things. So and as I said, until recently, the last 2, 3, 4, 5 years, what's the problem for gold and gold stock? Well, the stock market is still going up. So all this money is still buying stocks. It's buying stocks. They don't need gold. So only a little money is going into gold, and it's not going into the miners. It's not going into the silvers. It's not going into the juniors. And so I think just understanding capital flows and intermarket analysis is so important. And that can even take you a step closer to understanding what narrative might develop. So I know I keep coming back to that, but that to me is such a game changer in terms of technical analysis and market analysis. And you don't have to be a technician like you or I. I mean, you could just get a charting platform and look at, how's gold doing against the stock market? How's gold doing against silver? Like another potential narrative in the future. I tweeted something this morning. I don't have a strong opinion, but did the gold silver ratio just peak in the last couple days? And so, I honestly don't know. I mean, but I do know, or at least I strongly believe that silver is a really, really good opportunity. Silver and the silver stocks, at some point, that's going to really outperform gold. I don't know if that's going to start, in a couple days, or is it going to start in 3 or 6 months? I don't know, but the way that's setting up, we know that at some point that's very likely. And I do think the next leg higher in gold, I do think, not to trail too off, but I do think it's setting up where, even though gold's in a correction and consolidation, the miners could start to outperform. I haven't talked about it that much publicly, but there are some examples in the 2000s where after gold made a huge move, it made such a huge move, and then it corrected, consolidated for 6 months. But more money still was coming into the sector and wanted to come into the sector and get into precious metals. And I think we're at a very similar point. And this, the big money really only started coming into precious metals in the last month or two. So what could that mean? Well, depending on this correction in gold could correct and consolidate. And at some point during that period, all this money on the sidelines, that could start to come in. It could, buy miners, it could buy silver. And so those areas could outperform gold. And so as far as, and then when we know that when that starts to happen, a narrative will be attached to that. Like, oh, well, gold's gone up so much. Now people are looking at silver, and, the gold stocks are doing so. Yeah, I'm not sure what the narrative will be exactly, but if you're looking at charts and you're looking at capital flows and sentiment, how much money is in these markets, again, you can get a sense of what's we're not necessarily predicting this, but we're kind of anticipating what could happen. Then when it starts to happen, as you said, the narrative. I mean, I don't know. Can you think of a narrative like when the miners are out, they start to outperform gold, and like silver outperforms gold? I mean, yeah, there will be narratives attached to that.
Yeah. So silver, I'm glad you mentioned silver. I got a party favor here. This is a 100-ounce silver bar. It's interesting because I was looking at the gold silver ratio last week, and it was, above 100, starting to get a bit stretched. And I started thinking about silver and which stage of the cycle we're in. And yeah, literally in the last 2 days, I came to the conclusion that it's probably getting to be that time for silver to start to outperform. And then yesterday happened where silver was up like 3% and gold was down. Like, how often do we see days where silver is solidly green and gold is red? I mean, that happens like once or twice a year, maybe.
That's really rare. Yeah, I'd like to look that up, and I'm sure someone will, but it's nice where someone could look that up and they could put it on a chart and we can see when that happens. I mean, yeah, maybe it happens after the gold silver ratio peaks.
Yeah, so the gold silver ratio, so that's another topic, because a lot of people throw out gold silver ratio. In my experience, being an analyst and following this stuff for like 20 years, is I get almost no value for the gold from the gold silver ratio. The only times where I feel talking about the gold silver ratio actually is value added from an investment or trading process is at extremes. So literally I'm talking about like May or like April, May 2011. It got very extreme to the downside where silver was relatively overpriced compared to gold. And that roughly coincided with a major top in silver. However, I say roughly because if you actually look at that period, spring 2011, you might have said silver is stretched at 30 or 35. Well, it went to 50. So it's very hard to guess when is the end of the move, right? We can see it in hindsight. And now the gold silver ratio literally reached 108 this week. So I think that 32 on the downside, that's extreme. 108 on the upside, that's extreme. Could it get more extreme? Could it get to 110? Could it get to 115? Maybe, but the odds starting, the rubber band at 108, the rubber band is so stretched to one side that I think odds favor some mean reversion, and it could be mean reversion back to 90 or 95, but definitely in favor of silver over gold once it gets so extreme. And what could the narrative be? I don't know. Something about global economy is not as bad as we thought. The tariffs are not going to be as big a deal as we thought. So, some sort of narrative like that. Maybe something on the solar panel side of the equation, or just maybe, oh, silver is actually a little bit of a monetary metal too. So getting silver more into the monetary sort of conversation, which obviously gold has been dominating. I want to pick your brain about real yields and the yield curve. I think this is a very important topic, and I don't think it's well understood by a lot of gold investors. So for the last decade or so, basically since the global financial crisis, there's been this consensus or conventional wisdom that the time to own gold is when real yields are negative. And when real yields are positive, that's not the time to own gold. That's when gold is going to be out of favor. Can you unpack this a little bit for us? And what are some of the shifts that we've seen in the last couple of years in terms of gold and real yields?
Yeah, this is very important. This revolves around the bond market and being in a secular bear, which is new. And actually, when I was, a couple of years ago when I started working on the book, I in the first chapter of the fundamentals, we didn't have a confirmed secular bond bear yet, so I wasn't talking much about it, and I was all about real rates and real yields, which according to PIMCO at some point they wrote something where they said the real 10-year yield, it's inversely correlated to gold, and that's the best indicator, which is true when you're not in an inflationary environment. But when you're in an inflationary environment, and especially an environment where bonds are in a secular bear, as they were from 1965 to 1982. And as we've seen in the last couple of years, there are periods when interest rates are rising, or long-term bond yields are rising because people are selling bonds. And and because of that, you're kind of getting artificial strength in real yields where their real yields are popping up considerably because long-term rates or long-term bond yields are rising, again, because people are selling bonds. And that we've seen that in the last few years where, I haven't looked at the real yields recently, but, real yields did pop. And, I think they're fairly positive. And, gold, of course, has been ripping. And so people who stayed with that correlation, because I've seen people on Twitter talk about a couple of years, gold should be, look at real yields, gold should be 1,200 right now, or gold should be 900.
That's a really important point. So literally since 2021, I get so many tweets at me that I'm wrong to be bullish on gold, and they flash the real yield chart. And they were missing something big. So keep going.
Yeah, so I mean that is such, and even it even took me a little while to figure that out. I was even though real yields were rising, I was really connected to the point where there are and this is true, there are some points where gold actually leads real yields at major turning points. So even though real yields are the best single indicator for gold does lead them at major turning points. But you have that. But again, this gets back to the major asset classes and a big theme in the book. Bonds from 1920 to 2020, Goldie, the only period you lost money on bonds was really like the mid 60s to the early 80s. So we are back in that period, and people have been really, really slow to figure that out. And as you know, bonds, this is the biggest asset class. So this is just shit tons of capital. And people who could be in treasuries and earn 2 or 3% on big money. I mean, pension funds, really high net worth investors, they can stick their 5 or 10 or 20 or 50 or 100 million in treasuries, no problem. They're making great income off that, great nominal income. But if you're managing that amount of money and you're thinking right now, like, gosh, what can bonds are a mess. I mean, we have inflation. The fiscal situation is terrible. Where am I going to put this money? gold is one. And again, this is where intermarket analysis and charting things against each other comes into play. I'm sure you've used this chart once or twice, looking at gold against bonds. I mean, that thing in the last couple of years has basically gone vertical. And so that, from that chart, okay, this is telling us capital is coming out of bonds and it's moving into gold. And so again, circling back to real yields, during the past few years and also periods in the mid to late 60s and 1970s, because long-term bond yields were rising, real yields were artificially strong. But that was more a reflection of rising inflation expectations, fear of inflation, more so than, we have strong growth and the economy is doing well, and so people are pulling their money out of bonds because of that. There's a big difference. And so we are seeing, not a perfect repeat of that, but we are seeing a repeat now where, again, in the last couple, 2-3 years, money has come out of bonds. People are selling bonds. Long-term yields are rising. So real interest rates are artificially high. But the people who are selling bonds, that money's going right into gold. And that, along with other factors, has moved gold higher. And yet, one more thing on the yield curve. The difference between long and short-term yields, that's really important, because when it goes from, typically the yield curve is flattening, where the difference between the two yields is positive, but it's declining. You start to get a boom or a bull in the stock market. Then when it goes negative and inverted, you're kind of towards the end of a boom. And then when it comes back above zero and starts rising aggressively, steepening, they call it, that's a sign of a recession or a real downturn. Now we have come up above zero, but we haven't quite, we've been really close to that spread, again, between long and short-term bonds, really close to the spread, really just breaking out or really surging or moving considerably higher. But we're close to that, but it has not quite happened yet. And so if and when that happens at some point, when you see that really starting to bust out and move higher quickly, that's going to be a warning signal that, okay, we're basically in a confirmed recession now. So that's how I look at the yield curve.
Yeah. So steepening yield curve is usually so when it's shifting from either slightly inverted or flat to steepening, that's a sign that the Fed is pressing down on short-term rates, the economy is decelerating, and that's a good time to own gold. Is that what you're saying?
Yes.
Okay. And we're at a major tension point right now in the yield curve, but you can't call it, an official steepening yet, but it feels like it's coming, right?
Yeah, it's kind of been, it's above zero. It's been kind of meandering around. I haven't looked at it in a couple of days, but it hasn't. It's really, really close. Where, again, if we get a sharp move higher, that is basically your bulletproof signal right there that we're in a recession. But if it keeps meandering around as it did at some points I think in the mid 80s and the mid to late 90s, where it went above and it steepened a little bit, but it was meandering around in positive territory. It didn't have that, real vertical move, at least for a little while. That tells you you're not quite in recession yet.
Yeah. So the word uncertainty has been thrown around a lot the last couple of months, and there's uncertainty in all aspects of the macro picture, the global economy, tariffs, and market. So the yield curve and the tension that we're seeing there in the bond market and treasury yields is a sign of that indecision, of that sign of major uncertainty. But the cool thing from a technical analysis standpoint is we can follow these in real time and have an idea of different ways this could play out. And then once we get confirmation that it's playing out a certain way, then we can act on it. And it feels like this is one of those times to really pay attention. So also going back to the narrative, it kind of makes sense as there's this big indecision in how the economy is going, what's going to happen with tariffs, et cetera, how the yield curve is going to resolve, what the Fed is going to do next. That gold goes through a bit of indecision too, where it consolidates in a new trading range. It doesn't just keep going up $100 every day. It actually cools off for weeks or maybe even a couple of months. So again, price action, technical analysis, and then there's your narrative. It all locks in together. So speaking of narratives, another aspect of this bull market that has been a little difficult for some people and veteran market observers is, well, if people are buying gold at Costco, that must be a sign of a top. That because the retail crowd never buys in at a good time. They always buy the top. And so I've heard that thrown around a lot, that, well, sentiment is clearly too bullish on gold. And if people are buying gold at Costco, that's not a good time to buy gold. So what do you make of that, and gauging stuff like Costco buying as a sentiment indicator?
Well, I think you have to be careful about anecdotal sentiment indicators. You always hear this, oh, I talked to, my cab driver. I knew gold was peaking, when my cab driver said this. But it's interesting, actually. I think in the 1980s, like, people lined up and they turned their silver in at the actual peak. So that was, so the public maybe necessarily wasn't wrong, but yeah, you got to be careful with anecdotal sentiment indicators, because you can't put those on a graph or look at an image and compare over time. Like, how did this? Okay, well, where was this in the mid 2000s or 2011 or 1980? I am always that way with charts. Like, any chart that goes back, or any piece of data that you have, like, I love to see it going back. Give it to me over 100 years. Like, Luke Groman had a really good, I forget what it was, but I tweeted, I don't think I've got to reply it, but I tweeted, like, I would love to see this going back to 1930, because it was a chart that went back to 1980. Great. Let me see this going back to the last, major peak in gold relative to all other assets. So yeah, anecdotal sentiment indicators, they're really, I don't think they have a lot of value. I mean, it's because, again, you can't, how do you measure it? You're just looking at it by itself in a vacuum. It doesn't, okay, well, a lot of people are buying gold at Costco. Does that mean anything? And if gold put in a peak, and if it, peaks for, let's just say it put in a major peak and it's never coming back to 3,500, that will be used as an anecdotal sentiment indicator and a narrative. Like, people will, they will use that. Reporters, oh, well, all these people were retail and dumb money, they were buying all this gold at Costco. Like, when that happened, I knew it was peaking. So I think with anecdotal sentiment indicators, like, you have to be really, really careful, because you can't, like, there's no data that you can evaluate and compare to past periods. So yeah, and honestly, like, they're not, I have less knowledge about this, but, like, the physical demand, and, like, oh, there were so many people at that coin shop, or the coin shop was just dead. There was nobody there. It doesn't, most people who are buying and selling gold, like, they do it through the futures market. Their big money is, buying and trading these huge contracts. And so, that to me is really what drives the market. It's not just people buying a bar or two at Costco. So it's not, I would like to see some statistics as far as how much of the market, like, every day, do Costco purchases make up. I bet it's less than 1%. I could be wrong. I'm just throwing it out there.
Yeah, I think you got it spot on. I don't think we can ascribe much value to the anecdotal Costco buying indicator, or when Costco is sold out of their 1 ounce pumped Swiss bars. And actually, I started hearing about Costco in 2021 and 2022. Well, gold has done pretty well since then, and that's not a small sample size. That's 4 years of price action. It's a lot of transactions that have occurred since 2021. And frankly, if you were buying gold at 1,900 in 2021, you're doing pretty well here if you're still holding it. And I think that you made a point earlier I want to delve into a little more, and that is that, well, if bond market investors start diversifying into gold, well, that's just an absolutely enormous pool of capital. And then gold is outperforming the stock market. So then you have potential for more diversification flows there. Well, those are the two biggest pools of capital in the entire global financial system. And suddenly, if those, even a sprinkling of those, I'm not even talking about 1%, maybe 0.1% of those pools of capital flow to gold. Well, that's absolutely, enormous. I mean, gold is not a small market, but it's not as big as the global equity market or the global bond market, not even close. So, the guy, Joe Beercan, buying an ounce of gold at Costco is not really moving the market in any way, shape, or form. If whatever Norwegian sovereign wealth fund or the Saudi prince decides he wants to diversify 0.1% of his capital into gold, well, that moves the market. That's a big driver. So I think we need to think bigger picture here, that there are some seismic shifts in the world happening, and there are some potentially seismic shifts in terms of fund flows. And I notice your tie, the button on your tie, Nirvana, it makes me giggle because we had a conversation that I remember very well, November 2023, where I talked about Nirvana, and then we had a follow-up, Turbo Nirvana. And I just want to say that 2025 has been what I feel is gold shifting from Nirvana to Turbo Nirvana. And I could have never conceived exactly how this has played out and all the different drivers and the narratives for it, but it has been something to behold. So let's talk about what's possible here going forward. So looking ahead for gold, obviously it's had an enormous run. What are you seeing in terms of the gold market, near term, longer term? Have any of your levels, your targets changed?
Not really, I would say. I'm a little surprised at the strength, but I guess that's because I'm trying to not be like a permeable cheerleader. But looking at historical analogs and those types of things, I mean, gold can obviously, I mean, it almost hit 3,500. So like to say 5,000 by the end of next year, I mean, I think that's possible. Like it just seemed like a year ago or 3 or 4 months ago, it seemed like it was far-fetched. But looking at the cup and handle pattern, we did hit 3,000, the measured upside target. Now, I did look at historical cup and handle patterns I mentioned in the book that are not necessarily perfect. I mean, gold's cup and handle pattern is so pure and so perfect that it will be in technical analysis textbooks in the future. But looking at these other patterns, which are somewhat similar but more rough, they went from the measured upside target to the log target, every one of them in 6 to 12 months. So the log target is basically the percentage target. So if you're looking at, gold, like let's just say from 1,000 to 2,000, okay, you add the 1,000, 3,000 measured upside. What would the percentage target be? Well, that's 100%. So that gets you 4,000. But yeah, looking at specific levels, I mean, depending on how you measure it, the log target could be anywhere from, I think, 3,900 to 4,100, 4,200. So yeah, based on that history, you could go from 3,000 to 4,000 in 6 to 12 months. And we hit 3,000 2, 3, 4 months ago, a couple months ago. So yeah, I think 4,000 is the next target. But it really depends on this correction consolidation that we're into. I mean, if we get some real like nice bullish sideways action here for 3, 4, 5 months, I mean that could set up a real vertical type of move, to 5,000 and higher. So yeah, I think stepping back, the huge move that we've seen, now we're coming into a period which, again, from a bird's eye view, is looking like a pause. And the reasoning behind that, I mean, and you were talking about this just a moment ago. So first you had money coming out of bonds and buying gold, and there's still a long way for that to go. But now you have money coming out of stocks and going into gold. That started in the last couple of months. And, this is my gold against the 60-40 indicator. So gold against the total return of a stock portfolio, that's 60%, or total real return, that's 60%. And then you have 40% in bonds. So I put that together with a lot of historical data. And that gold just broke out of a 10-year base against that portfolio in March. And so you break out of a 10-year base, and also the gold cup and handle, it's only a year from that breakout. So it broke out of a 13-year base. You have a 13-year base in nominal terms it broke out of. A month ago, it just broke out of a 10-year base against the 60-40 portfolio. That tells you how early we are in this move away from conventional assets into gold. And then if you look at fund flows, which you mentioned, if you look at ETF assets, those relative charts on Twitter, it's the move into gold has barely started. And again, that's why you look at all this stuff and you piece it together. This would be different if the fund flows and all the assets had already been going into gold for 5, 6, 7 years. Like, we would be in a different situation. And again, this is a big, everybody's worried about a 2008 repeat. Well, in 2008, gold and precious metals were already moving up for 7 years. You had 7 years of money going into precious metals. That hasn't happened yet, even though the market has gone up in price the last 6 or 7 years. The fund flows, the capital flows, who is buying? It's been very, very little buying. And now we see gold breaking out against a conventional portfolio. Again, a year after it broke out of a 13-year cup and handle pattern. And I talk about this in the book. Those breakouts, and this as a technical analyst, they lead to big, long, and sustained moves. This is you don't break out from those kind of bases and have a big move for a year or two, and then you just peter out. Like, we are in the, these breakout moves, we are in the still in the very early phase. So putting that all together, I do see that there's serious risk that, gold could really accelerate after this correction. And that doesn't mean that I'm, doing reckless investing and buying out of the money calls and that.
But I thought you were long the 3x gold miner ETF, Jordan.
No, I learned my lesson. I learned my lesson on that a long time ago. But yeah, no, those are enticing. But yeah, but no, I see serious upside risk. And based on the history I studied with respect to silver, when does silver really begin to outperform gold? It's after that first breakout move in gold, because what happens is you get a breakout move in gold, and then it corrects and comes back and tests the 200-day moving average, or close to it, or maybe goes a little below it. And once that correction is over, that's the point when silver really, really strongly outperforms. So if my thinking and my view here, if the market trends this way, or somewhat close to it, I do think that silver is set up for, or there's real potential where it could really start to move. And that also aligns with just looking at silver by itself. Like, I was looking at the quarterly chart of silver the other day. So we had a quarterly close, I think, just below 35, which was, I want to say, the fourth highest quarterly close ever. The highest quarterly close ever in silver was 37. If you look at, and there's some closes, a couple closes at 35, and then we closed, I think, in the 34s. So silver, we all know what happens when it breaks 50. There's no resistance. It's blue sky. But what happens when it breaks 35 or 37? There's very, very limited resistance there. So we're piecing this all together. We're looking at gold. Okay, when does silver start to outperform? It's after that first correction post breakout. And then we're looking at silver, and it's like, okay, shit, if this thing takes out 37, it's really, really going to start to move. And that makes sense. That's when it should outperform, because when it breaks above 37, there's basically very, very limited resistance until 50. And then at 50, you've got nothing. So technically, that's another reason why silver is underperformed. Gold broke above 2,100 a year ago, blue sky to 3,000, that target. Nothing but blue sky. Silver has had to chew through all this resistance, 26, 28, 32. Now it's 34, 35. So when silver takes out 35 and then 37, it's got nothing, no resistance, basically, a little bit at 50 from that point forward. And so that is going to line up with silver really starting to outperform gold.
Yeah, it's very good point.
Yeah. So last thing, I think we could have a spectacular year in the next year, or 12 to 18 months. Like, there's a real risk of that, where we could, again, we're having a correction now, but after that, we could really accelerate higher. And this is when, again, more capital could come into silver at that point, but also into the miners and the stocks, because they're in a real sweet spot here where you don't really have major cost pressures for mining.
Yeah. Silver is an interesting one. And I'll give you another anecdote. I was in Tampa last week and I was in a coffee shop or something. And this guy was just going on about silver and fungibility of money and Bitcoin and how it's not fungible. And he was actually very eloquent. He wasn't talking to me. He was talking to somebody else. And I was snooping in on the conversation. He went on for 30 minutes and made a very compelling case for physical silver. Looking at this chart that you mentioned, the monthly or quarterly silver chart. Yeah. So, I look at it from a trader standpoint and I say, like, okay, risk is 30. If it breaks 30 on like a weekly or monthly closing basis, I'm stopped out of a trade. Just talking about trading here. I'm not talking about investing and owning physical. Just like if I was trading futures, I would go long, stop under 30, and I'd be looking for that breakout above 35. And obviously, yeah, if it breaks out above 35, certainly on a monthly closing basis, 40s are fair game. And, could it go to 41, 43? I have no idea, but it could definitely have a lot of room there. And then obviously that big psychological level, that nominal double top at 50 or 49 or 50, that obviously looms large. But from 33 to 49 that's a huge move for silver. That's a 50% move in silver. So from a risk, reward standpoint, silver looks pretty compelling here. But people that are watching this and thinking that this is like a 1 day or 2 week trade or something, no, it's not that. We're talking about monthly and quarterly charts. So this is a move that could play out over 12 to 18 months, maybe even longer. It's not. But what's really interesting is you brought up the context of all the different charts, the 60-40 portfolio, gold, nominal, long-term chart, that cup and handle, and now silver. So if you look at just like the monthly silver, it's been bumping up to this 33, 34, 35 area multiple times. And it just had this shakeout earlier this month where it flushed the stops under 30 and then came right back. The fact that it snapped back the way it has is, to me, that is extremely bullish price action, because it like cleansed the market. It shook out a lot of traders, a lot of hot money, and then the real money just brought it right back up to the resistance around 33, 34. So it'd be really interesting to see how silver does play out. And then when we overlay it to the gold silver ratio, that's maybe another feather in the cap of the silver bulls here. Final topic, because I know we could go on for hours, Jordan. Mining stocks, and I don't want you to go on for 30 minutes, because I know that you could, but could you just unpack how a gold mining stock bull market tends to play out if we look back at history? How do these things usually evolve, or sort of what the time frames are, and where are we in this gold mining stock bull market?
Yeah, really good question. And their evolution, like, this is actually an important point, and I'll try and be concise here. The evolution has really changed, because gold stocks before 1971, they were gold. Like, if you wanted exposure to gold, you got it through gold stocks, which is why I said gold stocks in the mid 60s, they broke out of a 27-year base. That, to me, was similar to gold breaking out of a cup and handle last year. And so, people forget about the night. You see lots of people posting, like, they do these charts about how gold stocks are bad and they started in 1970. And I'm sitting here thinking, bro, you forgot about the 1960s. Like, they had a huge move. Like, they were artificially relative to gold at a really high point in 1970. So you're missing, again, this is why you have to look at 100 years of history. You can't just cut off at random points. But yeah, and I'm going off on a tangent because history has changed so much. Okay, and even until 2004, 2005, the best way to get exposure to gold was by buying the gold stocks. In 2004, 2005, now people could buy gold and silver easily through the ETF. So that hurt the gold stocks quite a bit. And then, you had of course, the secular bear from 2011 to 2023. Like people who are bitching about gold stocks, they have terrible managers and these companies are bad and all of that stuff. Not one mentioned they're in a secular bear market from 2011 to 2023. Again, narratives follow price. Goldie, the narrative that followed price in a bear market. Why aren't we hearing about that now? I'm not seeing on Twitter people talking about gold stocks sucking and
it's
these people.
There's still a bunch of them. Newmont had a great quarter yesterday. I made a couple of tweets about Newmont, and you know what? Yeah, I got a lot of engagement, a lot of retweets because obviously my audience, but the actual comments, the people who took the time to actually reply something, almost 100% negative. So they tried to point out aspects of the quarter that weren't good and say, oh, well, Newmont's still going to fall. Watch. So the fact that the biggest gold producer in the world can report a great quarter with record free cash flow and people still find things to be negative about, I think that tells us about sentiment.
Yeah. It's an anecdotal indicator, but it's a good one because it's like a direct response to something that just happened. But as far as how this bull, I'm mentioning the history because it's changed so much. How could the bull market play out? Well, typically the miners and the juniors, like in the mid, they really outperform in the middle because you're in a real sweet spot. Like towards the end, when you start to get inflation coming through, that hurts the margins. So typically, it begins, I guess, people, because before the ETFs, before 04, 05, that the miners did lead gold at that point because they were the best replacement. Now you have gold that leads first, then money goes into the bigger companies, then it goes down into the best juniors, then into, silver stocks and exploration companies. So we're kind of, I think where we are, we're getting into the real sweet spot where in the next 12, 18 months, like you're going to see money start to flow down to all the juniors, to exploration. And again, the 12 to 18 months, we're in a real sweet spot where, maybe I'll be wrong, but I don't see inflation, at least cost pressures, really coming back for another 12 or 18 months. If their costs go up 10 or 15%, that's fine. Because they're, the real price of gold has gone up so significantly. But, another thing to think about, the inflation adjusted price of gold and the inflation adjusted price of gold, silver. If you look at the inflation adjusted price of gold or silver, and you look at just, a stock index below it, they track really, really well. And so gold against the CPI, this is just broken out of a 45-year base as far as a monthly chart. And so not that many people are talking about this. This is at a time when margins for gold producers are already at records. Like they are absolutely killing it. Like they don't even need margins to move higher. Even if margins would go lower by 10%, like most of these companies are killing it and they still would kill it. But we have broken out of a 45-year base, which suggests that there could be some real damn upside pressure to the real price of gold. So these company margins, there's a chance that they can get really insane over the next year or two. And again, because if you look at gold against the CPI, and then you look at the Barron's Gold Mining Index, or you can put GDX there for the last 25 years, they track really, really closely. And that's because the gold companies, they don't follow the price of gold. They follow the real price of gold, which is gold divided by costs. And so the best indicator for costs is CPI. You could also look at PPI. I haven't looked at that one yet. But again, this is so great about technical analysis and intramarket analysis. You could put all these things on a graph and discover, they can function as fundamental indicator. That is now a fundamental indicator for gold stocks. Gold divided by the CPI. We know gold against oil, that's a big part of it. You can look at those things on a graph. Those are fundamental indicators for the miners. So, the short of it is we're in a really good situation right now. We're getting into the sweet spot of this bull market, and the inflation adjusted price of gold, again, just breaking out of a 45-year base. So in the next 12 to 18 months, we could see something really spectacular in this sector. And I think the correction now in gold, I think it's kind of like a pause, and this is, this may be your last chance to like really buy a lot of things here at a cheap level, because if I'm right, We're going to come into a real, potentially spectacular period over the next 12, 18 months, maybe beyond that, because you'll get some speculation. This cyclical move, I don't know how long that's going to last. Maybe you could get, a big move for a couple years, then you kind of get like a mild, 40 or 50% bear market instead of a 70% one. And maybe that sets the stage for like a final move into the end of the decade. But I just keep coming back to, we are in a real sweet spot now. And so I think, over the next few years, minors and juniors, silvers, they have a real chance where they can really kill it. When oil starts coming back and inflation starts getting embedded in the economy again, that's when you kind of know for the stocks, like, okay, we're getting near the end, because then you have huge margin pressures like you did in 21 and 22. But we don't have that right now. The real price of gold is kicking ass, and the real price of silver will follow when it breaks 35, 37. So I know it's a lot to take in there, but I'm really bullish over the next year or two.
So a real sweet spot. I mean, that's the summary of everything you said. This is the real sweet spot for precious metals and potentially for mining stocks. And it's not based upon the long-term trends, the long-term charts, the forces at work out there around the world. This is not a fleeting move. This is not something that's going to be gone in a month. This could be 12, 18, 24 months. I totally agree. And if we think back to prior mining stock bull market cycles, there was always like this wave of dumb M&A deals near the top. There was always like some crazy transactions where like somebody was buying a mine in the Arctic Circle for $2 billion and you're scratching your head. What is that? We haven't seen any of that, right? The miners are still being very disciplined. They're really focused on cost containment and optimizing their asset portfolio, divesting non-core assets. So that's the stuff you see at the start of a bull market cycle. We haven't seen $7 billion deals for single asset companies or any crazy stuff like that would normally market top. So I completely agree. Jordan, this has been a fantastic conversation. I really enjoyed it. Final question: how can viewers read your book and get access to more of your content?
Oh, go to thedailygold.com/book. You can get it for free there. You follow me on Twitter, X at The Daily Gold. Also have a YouTube channel, The Daily Gold. And publish all my content in those places. So would love for people to come aboard, and you can read the book and hopefully learn a thing or two and get yourself in position to really profit and make some big money in the next few years.
Thanks, Jordan.